Welcome. Today, we're diving into the world of PCE inflation. If you've ever wondered how economists and policymakers track changes in the cost of living, you're in the right place. The Personal Consumption Expenditures Price Index, or PCE, is a key measure used by the Federal Reserve to monitor inflation in the United States. In this video, we'll break down the process step by step so you can understand exactly how PCE inflation works and why it matters for everyone, from consumers to investors. Start with the basics. PCE inflation refers to the rate at which the prices of goods and services consumed by households change over time. Unlike other inflation measures, such as the Consumer Price Index (CPI), the PCE index covers a broader range of expenditures and adjusts for changes in consumer behavior. This makes it a preferred tool for policymakers when assessing the overall inflationary trend in the economy. First step in calculating PCE inflation is gathering data. The Bureau of Economic Analysis (BEA) collects information on what households are spending their money on. This includes everything from groceries and clothing to healthcare and transportation. The data is sourced from business surveys, government reports, and other reliable channels to ensure accuracy and comprehensiveness. Once the data is collected, the next step is to categorize expenditures. The BEA organizes all spending into detailed categories, such as food, housing, transportation, and medical care. This categorization helps analysts understand which areas are experiencing price changes and how those changes impact overall inflation. Not all spending categories are equally important. The BEA assigns weights to each category based on how much households typically spend on them. For example, if people spend more on housing than on entertainment, housing will have a higher weight in the index. These weights ensure that the PCE index accurately reflects real-world spending patterns. With categories and weights in place, the BEA tracks how prices change over time for each category. This involves monitoring the prices of thousands of goods and services across the country. The BEA uses a variety of sources, including retail data and service provider reports, to capture these changes as accurately as possible. Now it's time to calculate the PCE price index. The BEA combines the price changes in each category, weighted by their importance, to produce a single number. This index represents the average change in prices for all goods and services consumed by households. It updated regularly to reflect the latest data. To find the inflation rate, analysts compare the PCE index from one period to another, usually month over month or year over year. The percentage change between these periods is the PCE inflation rate. This rate tells us how much prices have increased or decreased over time, giving a clear picture of inflation trends. One unique feature of the PCE index is its ability to adjust for substitution. When prices rise for a particular item, consumers might switch to a cheaper alternative. The PCE index accounts for these changes in consumer behavior, making it more accurate than some other inflation measures. Prices can fluctuate due to seasonal factors like holidays or weather changes. To avoid misleading results, the BEA makes seasonal adjustments to the PCE index. This helps ensure that the inflation rate reflects underlying trends, not just temporary price swings. Economists often focus on core PCE inflation, which excludes volatile food and energy prices. By removing these categories, core PCE provides a clearer view of long-term inflation trends, making it a valuable tool for policymakers. You might wonder why the Federal Reserve prefers PCE over the Consumer Price Index. The main reason is flexibility. PCE adjusts for changes in consumer behavior and covers a wider range of goods and services. This makes it a more comprehensive and reliable measure of inflation. PCE inflation isn't just for economists. Policymakers, investors, and businesses all rely on this measure to make informed decisions. For example, the Federal Reserve uses PCE inflation to set interest rates, while businesses use it to plan pricing strategies. One of the most significant uses of PCE inflation is in setting monetary policy. The Federal Reserve closely monitors PCE inflation when deciding whether to raise or lower interest rates. Higher inflation may prompt rate hikes, while lower inflation could lead to cuts. PCE inflation also affects wage negotiations. As the cost of living rises, workers and employers look to inflation data to determine fair wage increases. This helps maintain purchasing power and supports economic stability. Investors pay close attention to PCE inflation because it can influence market trends. Rising inflation may lead to higher interest rates, which can affect stock and bond prices. Understanding PCE inflation helps investors make smarter choices. For everyday consumers, PCE inflation matters because it reflects changes in the prices of goods and services they buy. When inflation rises, purchasing power falls, making it more expensive to maintain the same lifestyle. That's why understanding PCE inflation is important for everyone. PCE inflation is reported both monthly and yearly. Monthly data shows short-term trends, while yearly data highlights longer-term changes. Both perspectives are valuable for understanding how inflation is evolving over time. The PCE index is considered highly accurate due to its comprehensive data sources and adjustments for consumer behavior. However, like any measure, it's not perfect. Analysts continuously refine the process to improve accuracy and relevance. Despite its strengths, PCE inflation has limitations. It may not fully capture regional price differences or the impact of new products. Still, it remains one of the most reliable tools for tracking inflation at the national level. Both PCE and CPI measure inflation, but they use different methods and data sources. PCE covers a broader range of goods and services and adjusts for substitution, while CPI focuses more on out-of-pocket expenses. Understanding both helps paint a fuller picture of inflation. The Bureau of Economic Analysis, or BEA, is responsible for calculating and publishing the PCE index. Their work ensures that policymakers and the public have access to reliable, up-to-date inflation data. The BEA uses a wide range of data sources to compile the PCE index. These include business surveys, government reports, and retail data. This diversity of sources helps ensure the index is comprehensive and accurate. The PCE index is updated regularly, usually each month. This ensures that the measure reflects the most current spending patterns and price changes, keeping the data relevant for decision makers. Even if you're not an economist, PCE inflation affects your daily life. It influences interest rates, wage growth, and the prices you pay for goods and services. Understanding how it works can help you make better financial decisions. PCE inflation is a cornerstone of economic policy in the United States. The Federal Reserve sets its inflation target based on the PCE index, aiming for stable prices and sustainable economic growth. You'll often see PCE inflation mentioned in economic reports and news articles. It's a key indicator that analysts watch closely to gauge the health of the economy and predict future trends. The PCE index is directly tied to the cost of living. When the index rises, it means that the average household needs to spend more to maintain the same standard of living. This makes it a vital measure for understanding economic well-being. Government social programs such as Social Security often use inflation measures like the PCE index to adjust benefits. This helps ensure that payments keep up with rising prices and protect recipients' purchasing power. Businesses use PCE inflation data to plan for the future. By understanding inflation trends, companies can make informed decisions about pricing, wages, and investment, helping them stay competitive in a changing economy. Financial markets react to changes in PCE inflation. Higher inflation can lead to market volatility as investors adjust their expectations for interest rates and economic growth. That's why PCE data releases are closely watched events. The PCE index is also useful for comparing inflation across countries. While each nation has its own methods, looking at PCE inflation helps analysts understand how the U.S. stacks up globally. Economists use PCE inflation data to make forecasts about the future. By analyzing trends in the index, they can predict how prices, wages, and interest rates might change in the coming months and years. If you're interested in tracking PCE inflation yourself, the BEA publishes updated data on its website every month. The reports are free and accessible to the public, making it easy to stay informed. A stable PCE inflation rate is a sign of a healthy economy. When prices rise too quickly or fall too much, it can signal problems. That's why the Federal Reserve aims for a moderate, steady rate of inflation. Understanding PCE inflation can help you manage your personal finances. By keeping an eye on inflation trends, you can make smarter decisions about saving, spending, and investing. If you're planning for retirement, PCE inflation is especially important. Rising prices can erode the value of your savings over time, so understanding inflation helps you plan for a secure future. Banks and lenders use PCE inflation data to set loan rates. When inflation is high, borrowing costs may rise. Understanding this connection can help you make better decisions about loans and credit. Price stability is a key goal of economic policy, and the PCE index is central to achieving it. By monitoring inflation, policymakers can take action to keep prices steady and support economic growth. During times of economic shock such as recessions or crises, PCE inflation can change rapidly. Policymakers use the index to assess the impact and respond with appropriate measures to stabilize the economy. Technological advances can affect PCE inflation by changing how goods and services are produced and consumed. The index adapts to these changes, helping to keep inflation measures up to date with modern life. Demographic shifts such as aging populations or changing family structures can influence spending patterns and, in turn, PCE inflation. The index is designed to capture these evolving trends for a more accurate picture. PCE inflation often features in policy debates about the economy. Lawmakers and experts use the index to argue for or against changes in interest rates, taxes, and government spending. During periods of economic recovery, PCE inflation helps track how quickly prices are returning to normal. Policymakers use this information to fine-tune their strategies and support a balanced recovery. Wrap up: PCE inflation is a vital tool for understanding changes in the cost of living. By following a detailed step-by-step process, the BEA ensures the index is accurate and relevant. Whether you're a policymaker, investor, or consumer, knowing how PCE inflation works can help you make better decisions and stay informed about the economy.